Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what the big companies are really up to. And today we're diving into some real estate finance moves. So what exactly are we looking at today? This filing is an 8K report, which basically means Goldman Sachs Real Estate Finance Trust Incorporated, or G.S.R.E.F.T Incorporated as we'll call them, is reporting a significant event that the public needs to know about, and fast. Think of it like a company shouting out a major announcement not on their usual schedule. What is interesting here is that this company is a bit newer, and they're flagging themselves as an emerging growth company. They've also elected not to use the extended transition period for new accounting standards. That means they're on the hook to adopt new rules as soon as they come out, which can be tough for smaller, growing businesses. If you are curious about how these new rules might affect them, make sure you've subscribed. Also, we have a Discord community where we break down these filings further. You can find the link in the description below. Alright, let's get to the juicy stuff. The big event here is about unregistered sales of their stock. This means they sold shares, but they didn't go through the usual lengthy process of registering them with the government first. They did this because they believe it qualifies for an exemption, specifically under Section 4 Authorities Act, which is usually for private placements to sophisticated investors. They're telling us they sold Class I common stock and Class S common stock. For Class I, they sold over 259,000 shares for about $6.5 million. For Class S, they sold over 173,000 shares for around $4.4 million. Now, the note here is important for the Class S shares. That $4.4 million includes about $52,000 in selling commissions. So, the actual cash they pocketed before those fees was slightly less. And for context, when they talk about classes of stock like Series T, Series S, Series D, and Series I, they're actually considering them all as one big group of common stock. They just use these different classes names to sound like what other companies in this industry do. They are relying on buyers representing that they are accredited investors, meaning they meet certain income or net worth requirements. This is a common way for companies to raise capital quickly without the heavy regulatory burden of a public offering. Now, what about the money they're giving back to their investors or shareholders? They're announcing distributions for October 2025. For Class S shares, it is about $0.148 per S-share. For Class I shares, it is a bit more, $0.166 per S-share. They also have non-voting shares in Class F. iShares with distributions of $0.166 and $0.2051 per S-share respectively. These are the net amounts after any specific fees or costs related to each class are taken out. These distributions are for shareholders who own stock as of the 31st of October. And here is a key detail as of that record date. They no longer had any outstanding shares of Class T, Class D, and Class FI common stock. So investors in those specific classes won't be seeing any payments. These distributions can be paid out in cash or reinvested back into buying more stock if you are part of their reinvestment plan. Let's switch gears to what else this company is doing. They're making some significant loans, which is their bread and butter. On the 21st of October, they originated a $29.1 million loan for a 137-unit apartment building in San Francisco. This is a floating rate loan, meaning the interest rate can change over time, tied to something called SOFR, which is a benchmark interest rate. The rate is SOFR plus 2.40%. It is a 3-year loan with options to extend for 2 more years. The purpose of this loan is to help someone buy this property. Then, just a few days later, on the 24th of October, they financed a $40.6 million loan for a portfolio of 4 industrial properties in Buda, Texas. This one's to refinance existing debt. It is also a floating rate loan, SOFR plus 3.15% with a 2-year initial term and 3-1. Year extension options. Industrial properties are things like warehouses and factories. And most recently, on the 4th of November, they gave out a whopping $48.6 million loan for a large 369-unit apartment building in Austin, Texas. This loan is also to refinance existing debt. It's a 3-year deal with 20-year extension options, and the interest rate is SOFR plus 2.45%. So, we're seeing them actively lending money in the multifamily and industrial real estate sectors, with loan amounts in the tens of millions. And finally, signing off on this report, we have the Chief Financial Officer, Malika Sinha, on the 7th of November, 2025. So looking at this report, G.S.R.E.F.T Incorporated seems to be a dynamic player in the real estate finance world. They're actively raising capital through private placements, which shows confidence from investors willing to buy shares without the full public registration. This is a faster way to get money, but it also means these shares might be less liquid for the average investor. Their loan origination activity is strong across different property types and locations, particularly in Austin and San Francisco. They're making substantial loans for acquisitions and refinancings, and the interest rates they're charging, while variable, seem to be in line with market conditions. The distributions they're paying indicate a plan to return value to shareholders, though it is important for investors to be aware of which share class they own and what those specific distributions entail. A potential risk is their reliance on floating rate loans, meaning rising interest rates could increase borrowing costs for their borrowers, potentially leading to defaults or restructuring. However, the loan terms with extension options suggest they are building in some flexibility for investors. The key takeaway is that this is a company actively deploying capital and generating revenue through lending activities, and they are navigating the regulatory landscape by utilizing exemptions for their capital raises. Alright, that is our breakdown of G.S.R.E.F.T Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more in-depth discussions. Thanks for watching. See you next time.